The warning did not come from a YouTube commentator, a market entertainer, or a self-proclaimed guru. It came from billionaire Ray Dalio, the founder of Bridgewater Associates, the man who correctly anticipated the 2008 financial crisis 6 years early and built a $160 billion hedge fund by studying economic cycles across the last 500 years. And now, he says we are entering the most dangerous economic period in a century, a convergence of debt stress, geopolitical rivalry, and internal polarization that resembles the late 1930s more than anything we have experienced in modern times. While most investors are still focused on short-term market rallies, Dalio is making a decisive shift into 3 specific assets he believes can survive the turbulence ahead: gold, China, and tips. He is not doing this quietly. He has been outlining in interview after interview why the period between 2025 and 2028 could define the economic fate of the United States, Europe, and the global order at large. According to Dalio, the world is leaving the comfort of a long expansion phase and moving directly into the final years of a debt supercycle that historically ends with inflation, currency devaluation, and a structural reset. And instead of offering vague predictions, he is showing exactly how he is positioning his own capital before that reset arrives. To understand why he's making these moves and what he sees coming, we have to start with the one thing that has guided his decisions for half a century: the cycle. Ray Dalio did not build the world's largest hedge fund by chasing headlines or reacting to fear. He built it by understanding how economic systems move in patterns and why every major financial crisis follows a predictable sequence that most people fail to recognize until it is too late. To understand why his shift into gold, China, and tips matters now, we need to go back to where his credibility was forged, his ability to anticipate turning points long before they become visible to the public. Dalio founded Bridgewater Associates in 1975, starting from a 2-bedroom apartment in New York, and over the next 5 decades, transformed it into a firm managing more than $160 billion in global assets. But it wasn't size that made Bridgewater influential, it was performance. From 1991 to 2020, while the S&P 500 returned roughly 10% annually, Bridgewater delivered about 12% after fees with only half the volatility, a rare combination that signaled not luck, but mastery of risk. His most famous triumph came in 2002, when he published internal research outlining how a growing bubble in subprime mortgages would unravel, how defaults would cascade through the banking system, how the Federal Reserve would be forced to print unprecedented amounts of money, and how gold would surge as confidence collapsed. When the crisis finally arrived in 2008, the stock market fell 57%, yet Bridgewater posted a 14% gain, a result that cemented Dalio's reputation as the investor who understands how the machine works. And it is that same machine, the long-term debt cycle, that Dalio says is now entering its most dangerous stage since the 1930s, setting the stage for the turbulent 2025-2028 window he keeps warning about. The machine Ray Dalio refers to is the long-term debt cycle, a repeating pattern he documented across the last 500 years of economic history. And once you understand how it works, the warnings he is giving about 2025-2028 stop sounding dramatic and start sounding inevitable. Every major economy moves through 4 stages: expansion, acceleration, peak, and deleveraging. And while the early phases feel prosperous, the final phase always delivers the same outcome: a reset through either widespread defaults or large-scale currency devaluation. For most of the post-World War II era, the United States lived through the healthy part of this cycle. From 1945 to 1965, debt was manageable, productivity soared, and the middle class expanded as growth was driven by real economic output rather than borrowed money. But beginning in the 1980s, the country slid into the second phase, acceleration, where borrowing grew faster than income. Cheap credit fueled housing booms, corporate leverage, market bubbles, and a false sense of wealth even as debt burdens quietly mounted. By 2007, debt to GDP had climbed from 35% to 100%. And when subprime borrowers finally failed to meet their obligations, the fragile structure collapsed. The crisis of 2008 marked the entry into the third phase, peak, where debt loads become so heavy that interest payments absorb more cash flow than investment or consumption can generate. Historically, this is the moment when an economy transitions into the fourth phase, a painful but necessary deleveraging that clears the system. But that did not happen. Instead of allowing debts to fall back to sustainable levels, policymakers intervened with bailouts, zero interest rates, and more than $4 trillion in quantitative easing, preventing the reset and pushing debt even higher. As a result, the United States now enters the mid-2020s not after a cleanup, but after a postponement, carrying 132% debt to GDP, rising annual interest costs, and the same structural imbalances that toppled past empires like Great Britain in the early 1900s and the Dutch Empire in the 1600s. And it is this unresolved, enlarged debt burden, combined with geopolitical rivalry and internal polarization, that Dalio believes is converging into the dangerous window between 2025 and 2028. The reason Ray Dalio is repositioning his wealth now is not because he expects a normal recession, but because he sees a confluence of forces that historically mark the final stage of a major debt cycle. And to survive that stage, he is moving into three specific assets he believes can withstand inflation, currency devaluation, and global instability. The first is gold, a position Dalio has been building since 2019, and one he describes not as a speculation, but as insurance against the erosion of purchasing power. Gold does not depend on a government to repay a promise. It has no counterparty risk, and throughout every major fiat collapse, from Weimar Germany to Argentina to Venezuela, the holders of gold preserved wealth, while holders of currency were wiped out. With the United States now carrying $36 trillion in debt and annual interest costs projected to reach $1. Errors. $8 trillion by 2027, Dalio expects policymakers to choose the path used by every overextended empire before them: print money, devalue the currency, and allow inflation to silently liquidate the debt. In such an environment, he believes gold could rise from roughly $2,700 today to $5,000, $10,000 per ounce by the end of the decade, not because gold becomes more valuable, but because the dollar becomes weaker. The second asset is exposure to China and other emerging markets, a move that has drawn criticism but aligns with what Dalio calls the changing world order, the long-term shift from a declining global power to a rising one. While Western media focuses on China's real estate crisis and political risks, Dalio focuses on structural fundamentals. 77% debt to GDP compared to America's 132%, a 35% national savings rate, and the world's most extensive manufacturing base. In past transitions, when the British pound lost reserve status to the US dollar, capital migrated toward the rising power. Dalio believes the next transition will create similar flows over the next 20-30 years, which is why Bridgewater maintains nearly 20% of its portfolio in Chinese and emerging market assets. The third category is inflation-protected assets, TIPS, commodity exposure, and real estate with pricing power. These assets breathe with inflation, adjusting upward when currency value declines. Historically, in high inflation eras like the 1970s, financial assets tied to currency underperformed dramatically, while real assets preserved or expanded purchasing power. Dalio's view is that if the US solves its debt crisis through money creation, as every prior empire has, these inflation-linked assets will be critical to survival. And it is the combination of these three positions, gold, China, and emerging markets, and inflation-protected assets, that forms the foundation of his strategy heading into 2025 to 2028, a period he believes will test the resilience of currencies, markets, and political systems across the Western world. For Ray Dalio, preparing for the years 2025-2028 is not about predicting the exact month a crisis will erupt. It is about structuring a portfolio that can survive the full range of outcomes when a highly indebted system begins to unwind, and that philosophy forms the basis of the playbook he has been refining for decades. His approach centers on a simple principle. In a late-cycle environment where debt levels are unsustainable, where governments are forced to choose between default and currency debasement, and where geopolitical and domestic tensions are intensifying, the priority is not maximizing short-term returns, but avoiding catastrophic losses that cannot be recovered once the system resets. This is why Dalio allocates roughly 45% of his strategy to the trio of assets he considers essential for late-cycle resilience: gold, emerging markets led by China, and inflation-protected assets such as TIPS, commodities, and real estate with pricing power. Gold functions as the insurance layer, a shield against a devaluing currency when policymakers resort to large-scale money creation. Exposure to China and other emerging markets provides a structural hedge against the decline of the existing global reserve power, echoing past transitions when capital migrated from the British Empire to the United States in the mid-20th century. And inflation-protected assets serve as the portfolio's breathing mechanism, rising in nominal value as inflation accelerates and the purchasing power of the dollar weakens. Dalio then pairs these positions with a substantial allocation to cash-like instruments, primarily short-term treasury bills, which offer liquidity without locking investors into long-duration bonds that could be crushed by rising inflation or sudden rate swings. This liquidity is not meant to sit idle. It is meant to create an opportunity. In every major deleveraging of the past 500 years, the investors who preserved their capital during the crisis were able to buy undervalued assets during the reset phase, the period when forced selling, collapsing confidence, and systemic restructuring pushed prices well below intrinsic value. Dalio's framework also warns against the three mistakes he believes most investors make late in the cycle: assuming policymakers will always be able to control market outcomes, holding too much exposure to assets tied directly to the weakening currency, and preparing for the last crisis instead of the next one. In the coming years, he argues, the greatest danger will not be volatility, but the silent erosion of real purchasing power as inflation redistributes wealth from savers to debtors. That is why his strategy emphasizes durability over excitement, resilience over speculation, and positioning before the turmoil rather than reacting after it begins. And for those watching from the outside, the lesson is clear. If the architect of the world's largest hedge fund is restructuring his entire playbook for the years ahead, then the window to prepare is narrowing, not after the volatility arrives, but now, while the system still appears stable on the surface. The perspective of independent economists, macro strategists, and former central bank officials provides an important counterbalance to Ray Dalio's framework, not because they disagree with his conclusion, but because many of them are now observing the same pressures from different angles. When you examine their analysis together, a striking consensus emerges. The world is moving into a phase where debt, demographics, geopolitical rivalry, and structural inflation reinforce each other instead of offsetting one another. This convergence makes the mid-2020s uniquely risky, and it explains why several prominent experts now echo Dalio's warnings, even if they arrived there through separate analytical paths. Former Federal Reserve officials, for example, increasingly acknowledge that the central bank's biggest constraint is not inflation, but the government's rapidly rising interest expense. When federal debt was $10 trillion in 2008, a 1% change in interest rates was manageable. But with debt now exceeding $36 trillion, even a modest shift in rates translates into hundreds of billions in additional annual payments. As former New York Fed economist Peter Fisher recently noted, the United States has crossed a threshold where raising rates to fight inflation inflicts more stress on the government's finances than it relieves in the broader economy. This environment makes the return to money creation, either through rate cuts or new quantitative easing, increasingly probable. And once that door reopens, inflation becomes structurally embedded rather than transitory. Macro strategists studying long-term cycles see a similar pattern, but through the lens of historical leverage and credit fragility. Analysts like Lynn Alden, Luke Groman, and Zoltan Pozar argue that the financial architecture built after 2008 now depends on perpetually cheap liquidity to function. Corporate balance sheets rely on rolling low-interest debt, the Treasury relies on short-term financing, and global markets rely on the dollar's stability. In their view, when the Federal Reserve eventually pivots back to easing, whether in 2025 or 2026, the immediate effect may stabilize markets, but the secondary effect will be a renewed surge in inflation, driven not by consumer demand, but by the mathematical necessity of funding government obligations. This matches Dalio's expectation that the next phase will not resemble 2008, which was deflationary, but more closely resemble the 1970s, when inflation rose in unpredictable waves, each stronger than the last. On the geopolitical side, intelligence analysts and international relations scholars highlight a different dimension. The growing rivalry between the United States and China is not merely a competition of trade, but a structural conflict between a mature power facing fiscal constraints and a rising power seeking autonomy over global supply chains. Experts like Graham Allison, known for the Thucydides trap framework, point out that major power transitions often accelerate financial instability because they force nations to prioritize strategic spending even as economic capacity weakens. In this period, defense budgets expand, trade restrictions escalate, and supply chains fracture, all of which push costs higher and magnify inflationary pressures. This aligns with Dalio's view that external conflict is one of the three forces that typically converge before a debt cycle reset. At the domestic level, sociologists and political risk consultants warn about the rising internal strain within Western societies. Wealth inequality in the United States is now near levels last seen in the late 1920s, with the top 1% owning more than 40% of national wealth, while the bottom half owns roughly 2%. Experts at institutions like the Carnegie Endowment and Brookings argue that such disparities historically lead to political polarization, declining institutional trust, and unpredictable policy swings, each of which reduces the government's ability to manage crises cohesively. When fiscal strain, social division, and geopolitical rivalry all peak at the same time, small disruptions can become systemic. What is most striking across these expert viewpoints is not disagreement with Dalio's thesis, but an unexpected alignment. Debt specialists highlight the unsustainability of 132% debt to GDP. Geopolitical analysts highlight the structural tensions between Washington and Beijing. Inflation experts highlight the inevitability of further monetary intervention, and political scientists highlight the rising domestic instability in Western democracies. All of them, in their own fields, arrive at the same conclusion. The system is stretched in ways that make the next 3 to 5 years unusually fragile. This convergence of expert insight also reinforces why Dalio's strategic emphasis on gold, emerging markets, and inflation-protected assets appears increasingly rational rather than contrarian. Gold benefits when trust in currency declines. Emerging markets benefit when global power balances shift. And inflation-protected assets benefit when governments choose monetary expansion as the least damaging path. The timing, too, aligns with historical precedent. Major resets, from Britain's decline in the early 20th century to the post-war monetary transformations, often arrive after long periods of denial, during windows when markets appear stable, but the underlying mechanics are already breaking. Many experts now believe the mid-2020s represent such a window, and while forecasts vary, one message is consistent across the data, the history, and the expert analysis. Preparation must happen before the system reaches its point of forced adjustment, because once that moment arrives, markets do not offer time for careful decisions. They shift abruptly, compressing years of change into weeks or even days. As the world edges closer to the period Ray Dalio places between 2025 and 2028, the most important message he delivers is not fear, not fatalism, and not prediction, but preparation. Every cycle he has studied across the last 5 centuries shows the same pattern. The moment just before a major reset is the moment that feels deceptively calm. Markets rally, headlines reassure, policymakers insist the worst is over. But beneath that surface, the forces Dalio warns about, excessive debt, rising geopolitical conflict, and deep internal polarization, keep tightening until one catalyst finally exposes the fragility of the system. And when that catalyst arrives, investors who waited for clarity always discover the same truth. Clarity comes only after the damage is done. That is why Dalio has already positioned himself into gold, emerging markets, and inflation-protected assets, and why he has reduced exposure to the instruments most vulnerable to a weakening US dollar. His playbook is not a call to panic. It is a roadmap designed to protect purchasing power, preserve optionality, and ensure that when the dust settles, capital survives long enough to rebuild in the next cycle. The lesson for anyone watching is straightforward. Do not mistake temporary stability for long-term safety. The structural pressures that define this period are still building, and the window to act narrows with each passing quarter. If you want to follow how these forces evolve, the shifts in interest costs, the moves by the Federal Reserve, the rising tensions between the United States and China, and the signs that the reset phase is approaching, make sure you stay connected. In the months ahead, we will break down the indicators Dalio tracks, the adjustments he makes, and the signals that separate a temporary market rally from a genuinely dangerous turning point. Because if he is right, the next few years will reshape the financial landscape, and those who prepare now will have an advantage that cannot be recreated once the storm arrives.